Okay, moving on, we're doing the statement of financial position, our balance sheet, and we are on page 3. So we're talking more about the care classification assets. We did current and we did long-term investments. So, property, plant, and equipment, or PPE, which is not personal protective equipment. It wasn't, at least until the pandemic. Durable physical property, land, buildings, machinery, furniture, and wasting resources, such as timberland, minerals, and stuff used in operations. So most of them are either amortized buildings or depletable like timberlands. But remember, land is not depreciated because it never loses its value. Land improvements, however, are depreciated. So IFRS allows an option to carry these at fair value, which we'll do later. Right now we're just going to focus on historical cost. And as with all assets, property, plant, and equipment is written down if impaired. For example, inventory, LCNRV, means lower of cost, what it cost, or net realizable value. So let's say you had a bunch of old computers, storeroom. Their actual net realizable value now is probably less than what we had to pay for them. So we write them down to the lower. That's the same as impairment. And again, you're going to learn this in later chapters. Intangible assets. Resources that lack physical substance but provide economic rights and advantages. So, you've talked about this before. Copyrights, intellectual property rights, patents, franchise, trademarks, trade names, certain contracts, like customer service contracts. Now, if they have a finite life, they will be amortized. If they have indefinite lives, it'll be a cost. So they'll tell you either it'll be patent life of 5 years left, or just patent. This one would be amortized, not amortized. So it's really in the wording of the question. And don't forget, you have to write them down if they're impaired, and again, we'll be talking about at least a half a chapter of that. Now, other assets. Some of the items are included. Assets in special funds, non-current receivables, future income tax, you'll do that in 360. Property held for sale. Keep it away. Property, plant, and equipment. And then when we sell it, we know it goes to a gain or a loss. Advances to subsidiaries, as you know from, wrong class, 410. You don't know about subsidiaries yet. That's when you own more than 50% of the stock of a company, someone else's. You have control. They become your subsidiary, and if you make an advance. Now, when you do buy part of a company, and they're your subsidiary, you bought over %, that's called a business combination, and you can record the goodwill acquired. So what that means is let's say you come to buy my business, okay? And let's say the fair value of it is $2 million, okay? So my business, fair value equal million. But I want to sell it. And your company goes, oh, that looks like kind of a good deal. I wonder how much we're going to have to pay her shareholders. Well, it turns out there's only 3 shareholders. And none of us want to work together anymore. Do you think we'd let it go for less than $2 million if we really don't want to work together? Yeah, we might. Okay? So in that case, the difference between what you paid and fair value is goodwill. Okay, so if you paid 1.5 million, goodwill equals 0.5 million. You don't have to know how to do this. You can learn that in 410 a lot. So don't worry about that. That's just in case you're interested what it was. I really apologize for my voice, you guys. Okay, now we move on to liability. So those are all our assets. There's 5 categories. Liabilities, current liabilities, reasonably expected to be liquidated through the use of current assets, so within a year, or the creation of any other current liabilities. And this, actually, you guys should all be a review, but I do understand that some of you haven't done this for a long time. Accounts payable are listed first, but the rest are not present any consistent order. One thing I want to remind you, that everybody forgets unearned revenue is a liability. And while we're talking about that, I'm just going to flip back to page 2. So go back to page 2, and under current assets, don't get prepaid expenses. It says prepaid expenses. My writing is also wrong. And I only mention those are the 2 people most usually forget, or they reverse them, or they put prepaid insurance expense on the income statement. And if you want to understand those, I'd go back to whatever chapter in your intro book was on adjusting entries. And there's also on Wiley Plus, I think it's under resources, chapter they put in chapter 0, I think they called it. A review of the accounting. So I do that if you're having any questions with this. Okay, long-term debt obligations. Of course, they're not paid within the normal operating cycle. And don't forget, you have to separate out the portion due the next year as the current liability. So if you had a mortgage, I don't know, of $300,000, and principal payments next year would equal, I don't know, I'm just grabbing numbers here, you guys, 50,000. In your balance sheet, you would have current liabilities equal to 50,000, and long-term liabilities equal to what's left over. So 300,000 minus 50,000, 150,000. So don't forget you've got to split them up that way. So the last section, we've done assets, we've done liabilities. Now we're going to shareholders' equity. Capital shares. What goes in it is the exchange value of issued shares, and that is common shares and preferred shares. So common shares and preferred shares. You have to disclose the number authorized, so total available, total issued, and outstanding amounts is how many held outside the company. Now, contributed surplus, you might not know that one as much. Usually reported as one amount, but you will have subledgers for each type. And usually includes issued share premiums. Yeah, so pretty much each chapter in 315 and 316, once we get into the stuff, there's at least one contributed surplus account you've got to record. Okay. Now, retained earnings or deficit, that's when it's negative, or debit balance. The amount of undistributed earnings, presented as one item. Accumulated OCI and other surplus, unrealized gains on and losses, on available for sale security, certain types of donations, and so on. And again, as I keep saying, you're going to learn more about these in the upcoming chapters. So the additional information, information not presented elsewhere, anything that qualifies items in the statement of financial position. 5 main types of additional information. Contingencies, so future debt, like if you were sued and it was likely you would lose. The accounting policy, of course. Contractual situations, significant. Any other additional details and subsequent events occurring after balance sheet date, but before statements released. Okay, so that's the statement of financial position or balance sheet, and I'll start a new video.